Part 1, Risk On and Risk Off, the foundation of market cycles, plus 600 words. Financial markets do not move randomly. They move in cycles driven by collective investor behavior, liquidity conditions, and expectations about the future. One of the most important frameworks to understand these cycles is the concept of risk on and risk off. At its core, risk on and risk off describe how investors allocate capital based on confidence or fear. When investors feel optimistic about economic growth, earnings, and stability, they are willing to take more risk. This is known as a risk-on environment. When uncertainty rises and fear dominates, investors prioritize capital preservation. This is called risk-off. In a risk-on phase, capital flows into growth-oriented assets. Equities outperform defensive assets. High-yield bonds attract demand, and speculative assets such as technology stocks, emerging markets, and cryptocurrencies often experience strong rallies. Investors believe that the future will be better than the present, so they are willing to pay higher prices for expected growth. Risk-on behavior is usually supported by loose financial conditions. Central banks may keep interest rates low, liquidity is abundant, and credit is easily accessible. In this environment, money looks for return rather than safety. Volatility tends to be lower, and drawdowns are often bought quickly. On the other hand, a risk-off phase emerges when confidence breaks down. This can be triggered by inflation shocks, tightening monetary policy, recessions, geopolitical conflicts, or financial instability. During risk-off periods, investors reduce exposure to volatile assets and rotate into safety. Safe haven assets such as government bonds, the US dollar, gold, and defensive equities typically outperform during risk-off environments. Capital preservation becomes more important than return. Volatility increases, correlations across risk assets rise, and liquidity dries up. It is important to understand that risk on and risk off are not emotions. They are systemic behaviors. These phases reflect how institutions, hedge funds, banks, and large asset managers position their capital in response to macroeconomic conditions. Another key point is that markets are often forward-looking. Risk-on behavior can appear even when economic data looks weak, as long as investors believe conditions will improve. Conversely, risk-off behavior can emerge while economic data still looks strong, if investors anticipate future deterioration. This is why understanding risk-on and risk-off helps you avoid emotional decision-making. Instead of reacting to headlines, you learn to observe capital flows and positioning. Cryptocurrency markets are especially sensitive to these cycles. Bitcoin and altcoins tend to perform best during risk-on environments when liquidity is expanding and investors are willing to speculate. During risk-off phases, crypto often experiences sharp drawdowns as liquidity contracts and leverage is removed. However, risk-off does not mean the end. It represents a reset phase where excess leverage is cleared, weak projects fail, and long-term opportunities are created. Every major bull market begins after a risk-off phase. By learning to identify whether the market is in risk-on or risk-off mode, you gain a structural advantage. You stop asking, should I buy or sell? And start asking, what phase are we in? In the next part, we will explore how to identify risk-on and risk-off conditions using real macro indicators, rather than opinions or social media narratives. Part 2, how to identify risk-on and risk-off using macro signals, plus 600 words. Understanding risk-on and risk-off is only useful if you can identify which phase the market is currently in. This requires shifting your focus from price alone to macro-level signals and liquidity conditions. One of the most important drivers of risk cycles is monetary policy. When central banks are easing, lowering interest rates, expanding balance sheets, or signaling accommodative policy, markets tend to move into risk-on mode. Liquidity increases, borrowing becomes cheaper, and asset prices inflate. Conversely, when central banks tighten policy by raising rates or reducing liquidity, risk appetite declines. Higher interest rates increase the cost of capital, reduce leverage, and pressure valuations. This often leads to a risk-off environment. Another key indicator is bond yields, particularly U.S. Treasury yields. Rising yields driven by growth expectations can still support risk-on behavior. However, rapidly rising yields caused by inflation or aggressive tightening often signal risk-off, as financial conditions become restrictive. The US dollar is also a powerful risk indicator. In general, a strengthening dollar signals risk-off conditions. This happens because global liquidity contracts and capital flows into the world's reserve currency. A weakening dollar, on the other hand, usually supports risk-on behavior. especially for equities and cryptocurrencies. Equity market structure provides additional clues. In risk-on phases, cyclical sectors such as technology, consumer discretionary, and financials tend to outperform. In risk-off phases, defensive sectors like utilities, healthcare, and consumer staples gain relative strength. Volatility indices, such as the VIX, also reflect risk sentiment. Sustained low volatility aligns with risk-on environments, while spikes in volatility often mark transitions into risk-off phases. However, volatility alone should not be used in isolation. Another critical factor is global liquidity. Liquidity represents the availability of capital in the financial system. When liquidity expands, asset prices across the board tend to rise. When liquidity contracts, correlations increase and asset prices fall together. For crypto markets, liquidity is especially important. Bitcoin often acts as a high beta liquidity asset. When liquidity expands, Bitcoin benefits. When liquidity contracts, Bitcoin suffers disproportionately compared to traditional assets. It is also important to observe credit markets. Widening credit spreads signal rising stress and risk-off behavior. Tight credit spreads indicate confidence in risk-on conditions. One common mistake retail investors make is relying on single indicators. Risk-on and risk-off are regime-based, not signal-based. You must observe clusters of signals moving in the same direction. For example, a risk-on regime may include dovish central bank policy stable or falling bond yields, weakening US dollar, strong equity breadth, expanding global liquidity. A risk-off regime may include hawkish central bank policy, tightening financial conditions, rising volatility, strong US dollar, liquidity contraction. By viewing the market through this framework, you stop chasing short-term price movements and start aligning with structural trends. In the final part, we will discuss how smart money adapts strategies across risk-on and risk-off phases, and how you can do the same without overtrading or emotional decisions. Part 3. Smart Money Strategy. Across risk-on and risk-off cycles, plus 600 words. Smart money does not predict markets. It adapts to changing conditions. The key difference between professional investors and retail traders is not intelligence, but process. In risk-on environments, smart money focuses on exposure, not precision. The goal is to participate in upside rather than perfectly time entries. Position sizing increases. Diversification across growth assets expands, and drawdowns are treated as opportunities rather than threats. During risk-on phases, trends persist longer. Breakouts have higher follow-through, and momentum strategies outperform. This is why buying strength works better than buying dips in early risk-on cycles. In crypto markets, this often means higher allocation to Bitcoin first, followed by selective exposure to altcoins as confidence increases. Liquidity flows from large-cap assets into higher-risk segments over time. However, smart money always monitors exit conditions. Risk-on does not last forever. Signs of overheating, excessive leverage, and deteriorating liquidity signal that risk should be reduced, not abruptly, but systematically. In risk-off environments, the strategy changes completely. The priority shifts from growth to capital preservation. Exposure is reduced, leverage is cut, and cash becomes a position. Smart money does not try to catch falling knives. Instead, it waits for volatility to compress, liquidity to stabilize, and sentiment to reset. Patience becomes a competitive advantage. For long-term investors, risk-off phases are periods of preparation. This is when watch lists are built, weak assets are eliminated, and capital is positioned for the next cycle. One of the biggest mistakes retail investors make is using the same strategy in all environments. Aggressive trend-following strategies fail in risk-off regimes. Defensive positioning underperforms in risk-on regimes. The solution is not complexity but context. By identifying whether the market is risk-on or risk-off, you automatically narrow your decision-making. You know whether to focus on offense or defense. This framework also reduces emotional stress. Losses during risk-off phases are no longer personal failures. They are part of the cycle. Missed upside during risk-on phases becomes less painful when risk is managed systematically. The most successful market participants are not those who trade the most, but those who align with the dominant regime and avoid fighting it. Risk-on and risk-off cycles will continue as long as markets exist. Technology may change, assets may evolve, but human behavior remains the same. If you learn to read these cycles, you stop reacting to noise and start moving with capital flows. This is not about predicting tops or bottoms. It is about positioning yourself on the right side of the cycle, and that is where long-term consistency is built. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from MacroCycleLab. See you in the next video.